Today's inflation report wasn't exactly what we wanted to see, but I actually think the ingredients are starting to come together for a better rate environment going forward. Here's what I'm going to be watching going forward. Mortgage rates have been relatively stable recently, and we've seen some improvements from the highs that we've been dealing with earlier this summer. The biggest reason I'm optimistic right now is what's happening in the bond market. Treasury has been increasing purchases of longer-term Treasury bonds, which is providing some support to the longer end of the bond market. And we've also continued to see signs that the labor market is losing some momentum that could actually become an increasingly important for the Federal Reserve here over the next several weeks as we approach their next Federal Reserve meeting. Now, we did also get some less than perfect inflation news this morning from the PCE, or the Personal Consumption Expenditures Report, which was just about in line with market expectations, slightly hotter in some areas than we expected, which does make the Federal Reserve meeting in September a little more complicated. The one biggest things here going forward, though, and the most important part, is the story isn't simply inflation's too high, so mortgage rates are going to go higher. That is something that factors into it, but it doesn't automatically mean rates are going to increase. So right now we have several competing forces: inflation, employment, Treasury issuance and buybacks, and expectations for Fed policy going forward. And some of those forces are working in favor of lower mortgage rates right now, which helps us out. Now, with this, biggest things going forward, Kevin Warsh is going to be speaking at the Jackson Hole Symposium later this week, which will be something that can move the markets a lot, as that is when they tend to give some information as far as the outlook for Fed policy going forward. And then next Friday, there's going to be another big jobs report from the government, the BLS report. Now, last month's data was a negative job growth number, and if that trend continues, that puts the Federal Reserve in a tough spot where we have declining in jobs numbers, and then inflation that's kind of staying steady, not really improving, not really getting worse. So typically in those types of situations, if a rate hike comes through, it makes the job situation worse out there. So those are going to be the things that I'm going to be keeping an eye on. So if you're thinking right now, then you're still looking for homes. I don't think this is the market where you want to sit on the sidelines and wait for the perfect rate. Our job is to keep you informed, to make sure you're positioned to take advantage when the market continues to move in your favor. So keep looking at homes, keep out there. We'll keep watching the rates. Once you find the right house, be ready to act. And if rates come down and improve down the road, we'll be in touch to revisit those options going forward. That's your update for the week. Have a great one.